Hello traders, you are welcome to this video and you are welcome back to the Forex Geek channel. If you are passionate about Forex trading and eager to take your skills to the next level, then you are in the right place. Today, we are diving deep into a crucial concept that can truly transform your trading game, and that concept is breaking equity. All right. By the end of this video, you'll have a solid understanding of what breaking equity means, how it impacts your trading performance, and practical strategies to master it. So grab a notebook and let's get started. First, let's clarify what we mean by equity in the context of Forex trading. In simple terms, equity refers to the total value of your trading account. Okay? It combines your account balance with any unrealized profits or losses from your open trades. Okay? So understanding this concept is crucial because it provides insight into your current financial standing within the market. So why is breaking equity such an important topic? When traders refer to breaking equity, they often talk about the point at which your account equity dips significantly, which can signal a potential problem in your trading strategy or risk management. Okay, now it is essential to monitor your equity regularly because it can impact your ability to maintain open positions and make informed trading decisions. All right, now that we have a grasp of what equity is, let us talk about why managing your equity is vital for sustainable trading. Now, equity management helps you assess your risk exposure, okay, and determine the maximum drawdown you are willing to accept. By understanding how to manage your equity effectively, you can avoid unnecessary losses that could jeopardize your trading account. Now, one common mistake traders make is over-leveraging their accounts. When you increase your position size without considering the potential impact on your equity, you expose yourself to significant risks. A sudden market shift could lead to a rapid decline in your equity, triggering margin calls or forced closures of your positions. To avoid this, establish clear guidelines on how much of your equity you are willing to risk on each trade. All right. Now that we understand the significance of equity management, let's explore some effective strategies to maintain and protect your equity while trading. The first is set realistic risk parameters. Okay, always define how much of your equity you are willing to risk on a single trade. A common guideline is to risk no more than 1 to 2% of your total equity on any one trade. This approach helps you preserve your capital over the long term, allowing you to stay in the game even during losing streaks. All right. Secondly, use stop loss orders. Implementing stop loss orders is a crucial risk management strategy. A stop loss order automatically closes your trade at a predetermined level, limiting your losses if the market moves against you. This way, you are protecting your equity from significant downturns. Thirdly, diversify your portfolio. Okay, diversification can also play a key role in equity management. By spreading your investment across various currency pairs, you can reduce the impact of a poor performing asset on your overall equity. Now, this approach allows you to capitalize on different market movements while minimizing risk. Now, the fourth point is monitor your trades regularly. Okay, it's very, very important. Keep a close eye on your trades and be ready to make adjustments as needed. Okay, this means checking your equity frequently and analyzing how your open positions are affecting it. All right, if you notice a significant decline in your equity, it may be time to reassess your trading strategy and consider cutting losses where necessary. Okay, now it's not just only about that. Okay, there is also very important need to understand the psychological aspects of equity management. All right. So managing your equity isn't just about strategies and numbers, right? It's also about your psychology as a trader. Trader psychology is very important to know. Okay. If you want to be a successful trader, it's important that you understand the psychological aspects of trading. All right. Emotions can cloud your judgment, leading you to make impulsive decisions that can harm your equity. So now we're just going to be looking at a few tips to help you maintain a balanced mindset. All right. Now, the first is stay disciplined. Very important. It is paramount that you stay disciplined if you want to be a successful trader. Stick to your trading plan. Avoid the temptation to chase losses. All right. If a trade doesn't go your way, don't double down in hopes of recovering your losses quickly. This can lead to even greater declines in your equity. All right. Now, secondly, practice patience. Understand that trading is a marathon, it's not a sprint. Okay, you should be looking at the long-term success. You should be looking at your long-term goals. All right, building a successful trading career takes time, and you will face setbacks along the way. By being patient and focusing on a long-term success, you will be better equipped to manage your equity effectively. All right. Now, another point to note is reflect on your trades. Okay. After each trading session, take time to analyze your trades. What worked? What didn't? This reflection helps you learn from your experiences and improve your decision-making process moving forward. So it's important that you have a trading journal. You know, one of the benefits of having a trading journal is that you can be able to reflect on your mistakes. Now, when you have a trading journal, each time you execute a successful trade, you document the necessary information, the reason why that trade was successful, and what you did, like the parameters or the things you looked out for before entering that trade, how the market reacted and all of that. And then if you experience a loss, you also document, you know, the reason why you experienced that loss. If it was a mistake that you made, if it was over leveraging, you have to note it down. If it was, using a bigger lot size, and whatever the case may be, you indicate what the reason was for that loss in your journal. So next time you can be able to reflect on the mistakes you made and the steps you took to avoid such mistakes in the future, you know, all of that. And then you can be able to check out the reasons why some of your trades in the past were successful. So trading journal actually comes in very handy. It's an important document for every trader that wants to improve. All right. Now, as we wrap up this video, remember that mastering breaking equity is an essential step in elevating your Forex trading game. All right. By understanding what equity means and implementing effective management strategies, you can protect your capital and navigate the Forex market with confidence. All right. Now, if you found this video valuable, please give it a thumbs up and share it with your fellow traders. All right. Any other person you know who would likely find this video valuable or insightful, please kindly share with them. And then don't forget to subscribe to the channel so that you don't miss out on more updates. All right. Because we share a lot of updates on trading tips and strategies. So thank you for watching, and until next time, happy trading.